If you can properly select the best emerging managers, you have the potential of having those managers perform well north of a 3x. In my experience, when I was at Weathergage, we had one manager who produced a 9.3x fully realized at this point. We had another did 5.7x fully realized at this point. It's not that you can always get that kind of performance with emerging managers, but you have the potential to get that kind of performance with emerging managers.
Hey everyone, this is Prashant and I'll be host for the VC 10X podcast, and today we have Courtney McCrea with us. Courtney is a co-founder and managing partner at Recast Capital. Prior to co-founding Recast, Courtney was a managing director of Weathergage Capital, a boutique fund of funds that provided its clients with access to premier venture capital, growth equity, and micro VC partnerships. Venture fund commitments included both brand name funds and emerging managers. During her 10-year tenure at Weathergage, Courtney made commitments to 100 funds and 7 direct co-investments. Now at Recast Capital, she's focused on investing in the best emerging managers across United States and Canada. In this episode, we talk about Courtney's story and why she co-founded Recast Capital, why they focus on backing emerging managers, how they evaluate VC pitches at Recast Capital, how should VCs structure their decks, and what all information to include. What are the return expectations in the fund of funds model? Their dedicated programs to nurture underrepresented emerging managers. How they think about portfolio construction at Recast Capital, and so much more. So without wasting any time, let's dive straight in. Hey Courtney, so good to have you on the VC 10X podcast. How are you doing?
I'm doing well. Thank you for having me.
Yeah, it's a pleasure having you on. And to start things off, can we have your story and why you started Recast Capital?
Sure. So I have been in the private equity industry my entire career. I started most relevantly at a growth equity fund called Weston Presidio that I was at for 7 years. And I shortly thereafter moved over to the limited partner side. And for 10 years, I was one of 3 managing directors on the investment side of the house for a boutique venture capital fund of funds called Weathergage. And during my tenure there, I learned that institutional investors really need to have access to the best emerging managers in venture to get the returns everyone's looking to get out of their venture portfolio, but also to get the pipeline of the blue chip firms of tomorrow, because the venture capital community is always changing. There certainly are brand name venture funds that consistently put up superior returns, but there are other established venture firms that they just get time doesn't do well as general partners get wealthier and some of the best money makers decide they're going to pursue other interests. The returns get more muted, and if you can get access to emerging managers that are well positioned to outperform, you are going to potentially do better as they raise more right-sized funds and they're scrappy and hungry, and you're never more aligned as a limited partner than you are with an emerging manager in venture. So when I left Weathergage, I found a like-minded friend, my now partner of 3 years, Sarah, and she was at another fund of funds, Green Spring, now part of Stepstone, and we both had seen the same thing in the ecosystem. And so we started Recast as a platform to both invest in and be supportive of emerging managers in venture. And we define emerging as institutional funds 1, 2, or 3. And we know that as a well-built fund of funds, you say no more than you say yes. And we wanted to be more helpful to the ecosystem than we could be just out of our investment vehicle. And so we started with a tuition-free educational program for emerging managers in venture. And at this point, we now have had 96 funds go through that program.
Yeah, that's incredible to learn, and we're going to get to learning more about that program as well in detail. But first, so what I get from it is that you're focusing at investing in emerging managers. That's the mandate here, right? And I believe from your past experience as an LP, you've seen all different kinds of VC funds and how they perform over the years. So could you help us contrast between brand name VC funds, because some institutional LPs do not, or LPs want to deploy in those brand name funds, right? They are reluctant to move away from those brand name funds and go towards emerging managers. So, you being someone who is focusing on emerging managers, can you tell us some of the insights in terms of some numbers or stats you can share in terms of multiples on capital that emerging managers are able to generate versus what brand name funds are generating? Help us contrast the two.
Happy to. First of all, I do believe that a well-constructed venture portfolio includes both brand name and access to emerging managers in venture. I will say that when it comes to the established managers, you end up with a somewhat of a median return of 2x or 2.2x. The funds that do exceptionally well are doing north of 3x. Maybe occasionally you'll have a 4 or a 5x fund to the extent that you have a number of really outstanding companies in that portfolio. If you are producing as a venture early stage venture fund a 2x or a 2.2x over the life of your fund, many institutional investors would rather be investing in buyout funds that can put that type of performance up because they perceive it to be somewhat less risky. Emerging managers, if you were to invest in all emerging managers, the performance would be lower than what I just said. However, if you can properly select the best emerging managers, you have the potential of having those managers perform well north of a 3x. In my experience, when I was at Weathergage, we had one manager who produced a 9.3x fully realized at this point. We had another did 5.7x fully realized at this point. It's not that you can always get that kind of performance with emerging managers, but you have the potential to get that kind of performance with emerging managers. And that is what we believe to be the attractive part of this segment.
Absolutely. And if you don't mind sharing, give us a sense of how big are these funds that you're talking about that are returning somewhere close to maybe 9x or things like that. What's the size of that?
Those funds, they varied, but I would say
Okay.
they all were under $100 million. I'd say most of those funds were under $75 million. And that's,
Okay.
it's just the law of numbers. It's much
Absolutely.
easier to 9x a 30 or a $50 million fund than it is a, $2 billion fund.
Totally agreed. And we are also seeing a lot of micro VC funds, which are, some of them are even sub 10 million funds, right? So how does the dynamic even shift further in case of those funds? They can maybe generate 10, 20x, maybe 30x returns on those capital
They
possible?
they absolutely can. I mean, it's interesting. No one can live off of a $10 million fund. So hopefully it is a proof of concept fund that will allow
Yeah.
them to then be able to raise a larger amount of capital. But yes, certainly, a 10x fund has the potential of even a much larger multiple. I heard of a fund that was sub 10 million and they had early stage Uber exposure, and that the performance of that fund was exceptional. But is that repeatable? Is the question.
Right. Exactly. I agree. And you just mentioned about, if you can invest in the best managers, you can generate those amazing returns, right? So, who are those best managers in your opinion? What are their traits?
So it is much more of an art than a science, although there's a science element to it. You are looking for managers who are relevant with the entrepreneurs who matter. They have access to, for whatever reason, the managers who we believe are well positioned to outperform, the CEOs, the founders that are well positioned to outperform. They also need to, especially at the earliest stages of investing, they need to bring something to the table that allows them to get access to these companies. It can be that you're exceptional at writing code. You could be exceptional at helping them find customers, helping them recruit key talent. You could be exceptional at helping them with their PR game to the extent that that is relevant for that company. And so there are many different ways that you can become a venture capitalist in the earliest stages, and yet trying to find those managers who have got good investment judgment. Not only are they swimming with the right entrepreneurs, but they know how to pick the best ones. So there needs to be some evidence that you're a good picker. So for our investment portfolio, you need to have invested in companies. You need to have a track record of some sort. It can be a nascent track record, one that hasn't had realizations, but we need to understand why you thought those companies were attractive. We need to know why those entrepreneurs selected you. And it's helpful to the extent that you have co-investors or follow-on investors that we respect. And that is a third-party validation that the ecosystem believes in this company. And so we we are really looking for those managers that stand out, that are differentiated. When you meet with a lot of emerging managers, they start to blend together. No offense, but to the extent that you can see something that is different, something that is contrarian, and then you spend your time in diligence to determine whether it's contrarian good or contrarian bad, because it can be very close to one another. But it is, you're really looking for those managers that stand out in some way, and then you diligence whether or not your assumptions are accurate.
Absolutely, totally agree. And I believe a lot of VCs would be reaching out to you that if you're deploying currently or not. So, what's the best way, in your opinion, for VCs to reach out to LPs? Because sometimes VCs are not even sure that LPs have those funds to deploy or not, right? Are they currently deploying or not, right? That doubt is always there. Plus, what's the best way? Is a cold email good? Should you get a warm approach to it, get a common connection and try to connect, right? And then should you, what all information should be there in that first email? Or should you directly upload your deck there? Or should you wait to get some interest and then share your deck with them, right? Talk me more into this.
These are the questions that everyone asks, and unfortunately the answer can change tremendously depending on the limited partner that you're trying to engage with. Different investors need different things. I would say that mostly having a warm introduction from another LP or from a manager in their portfolio, or even someone who has a warm relationship with that LP, sadly, is the best way to get in. That being said, there are other ways. I am always encouraging managers to not rule out cold emails. I do think that you have to be more thoughtful in how you write it. In a perfect world, you are putting a multiple in there that your portfolio is sitting at, and that is enough to get someone to engage with your email. We all are getting way too many emails. To the extent that you can stand out in some way, ideally on performance, ideally on how you're differentiated or your network, very quickly, very succinctly. When it comes to putting in a deck, I'm always somewhat hesitant to do that, although it can expedite a process. So if you're going to be engaging with, for example, a public pension, it might behoove you to have a deck attached. One of the beauties of DocSend is that you can actually see to the extent that somebody has opened your deck. But I would recommend not putting a NDA, a non-disclosure or confidentiality agreement on that original deck if you want to send a link, because there are many institutions, not so much family offices, not so much foundations, but public pensions or consultants that cannot sign those agreements or click on that button. So that's my only caveat. But for us, we like to be as inclusive as possible, but there's a never-ending stream of emerging managers.
Yeah, yeah, absolutely. And we recently did an episode with a DocSense research lead, Justin, and I encourage listeners to check that out. And that shares in detail how you can leverage the insights that the platform shares, even for founders as well as VCs sharing their decks around. Awesome, Courtney. I believe you must have seen a lot of VC decks as well uh, over the course of your career. Uh, so, how do you evaluate these decks, and what are the key slides that are, in your opinion, must have in a VC deck, and that you look at the most while evaluating these decks?
Yes. It's interesting. You look at so many decks and you start to think it's a formula, and in some ways it is. I like to see the very first slide being one that says the size fund you're trying to raise, the strategy you're pursuing, and and then the next page should probably be about you and why you're the right person to pursue the strategy. Sometimes if you're investing in a less well-known industry, it is helpful to have some pages on why that's an attractive place to invest. However, the real secret is why you're the right person to pursue this investment strategy. And getting to that sooner rather than later is really critical. The other element that I think is very important is to prove some way that you have access to entrepreneurs who matter and that you have good judgment as to which of those managers to back. For traditional venture funds, it's rather straightforward. However, for emerging managers, you have to be a little bit more creative. And so, to the extent that you have an angel portfolio or a small portfolio that you've invested in, you can show who the co investors are or the follow on investors. You can also do testimonials from your entrepreneurs or from entrepreneurs that you would have invested in had you had the capital to invest. All of these strategies can help to make the potential investor in your fund confident that you are the right individual to pursue this strategy and that you have got good judgment as to what companies you want to back. The final thing I would say is be really thoughtful about each slide. Often slides are way too busy. And to the extent that you can, think about what you want the reader to take away from each and every slide and make sure that all the content on that slide drives to that conclusion. Too often, there are slides, especially by emerging managers, that are so busy that it would take me 15, 20 minutes to figure out what the point of that slide is. Less is more in many cases.
Absolutely, totally agree there. And let's talk about the entire process of this evaluation to the point of the funds being deployed, right? So, how long is the process and what are the different steps involved? If you can give us an insight into that.
So the answer to that question varies tremendously depending on the limited partner that you're talking about. Um, it is very important, I believe, for any venture capitalist when they're meeting with a prospective LP to spend some time upfront trying to inquire as to the LP's process, what their bandwidth is, have they actually invested in a fund like yours in the past. It allows you to determine whether or not this is a high priority LP for you. And so I would say that there are those investors who do invest in the first close and will be catalytic investors in your fund. But the number of those LPs are far and few between. And so finding them is really critical. For us, if we had one fund that we invested in that was the fastest process I've ever seen, and I've been investing in venture funds now for 12, 13 years. It was began and it ended in 30 days, and he went over his target by $10 million. In part, he was a spin out from an established venture firm that anointed him, but we were able to move very quickly, do the references we needed to do the research we needed to do, but we had to stop everything in order to move that quickly. Some big institutions just cannot do that. Some large public pensions, it might be they need to wait to fund two. It could be they need 6 months because they need to go to an investment committee. They need to get the buy in. So, really thinking about the investors that you are reaching out to. Some high net worth individuals will just make a commitment on a Zoom call. So being really thoughtful about who's actually going to get there early in your process, I think, is really critical.
Absolutely, totally agree. And like, there's always some opinions thrown around on how VCs should be building up their thesis to align with the thesis of the LP, right? So, do you believe in that? That okay, if an LP is requiring to invest in a fund that is focused on maybe fintech or a particular region, then the fund manager deciding, okay, I'm going to focus on that fund, and then asking for a commitment Do you think that makes sense, or that's not a good approach? Or let's say a VC is interested in going sector agnostic, right? Just focusing on a stage, right? And can that also be a good approach, or is it preferred to be a sector focused fund? What's your approach there?
So my opinion, which is a very strong opinion, is that venture capitalists should put a lot of thought and energy into what sectors they want to invest in, what stage they want to invest in, what type of portfolio construction and follow on strategy they want to pursue, whether or not they want to end up bringing on additional partners or if they want to be a sole GP. Figure all that out, iterate on that for a long time, and then find your LPs. You'll be whipped around. If you talk to 100 LPs, you'll have 100 different recommendations on how you need to change who you are and how you run your firm. And usually they just are trying to find a nice way to say no. Precursor, Charles Hudson, did this masterfully. He said, I want to have a very large portfolio. And a lot of LPs said, I don't believe in a large portfolio. And he was dogmatic about the importance of having lots of shots on goal for early stage investing. And he found his people and he ended up performing exceptionally well. So it's a numbers game with LPs. And to the extent that you determine that your strategy or how you're pursuing your business does not fit with a prospective LP, put down the phone, move to the next person.
That's very interesting. And what's your perspective on solo GPs and multiple GPs? Because we have discussed a lot on the podcast with VC managers on how they look at multiple co-founders or solo co-founders. So we have had that discussion. Let's take that one step behind on how you look as an LP into VC funds. Do you prefer multiple GPs or a single GP? What's your perspective?
I am completely agnostic between a solo GP and multiple LPs. I mean, well, multiple GPs. Um, I, in my former firm, backed many solo GPs. Not everyone can be a solo GP. I would not, for example, be a solo GP. But to the extent that it's your personality and the fund size and the structure of what you're doing, it makes sense for a solo GP. I think it's almost easier to diligence a solo GP because if you have 2 to 3 GPs that have never worked together, there is a lot of risk inherent in that. And you spend more time as GPs at an emerging managers fund with each other than you do with your own spouse. So one of the biggest issues with emerging managers that have 2 to 3 general partners that have all come together just for this fund, the chances of it splitting up is not insignificant. And when that happens, it is a very tumultuous time, and the performance of those funds tend to underperform. So I'm not saying that having more than one partner is a problem, but ideally you've spent some time, some cycles, knowing that you work well together and that you complement one another and that there's not going to be friction.
Absolutely. And at Recast Capital, you're following a fund of funds model. So can you tell us what are the return expectations from this kind of investing model versus the return expectations as we know from a particular VC fund? So how does that look like for a fund of funds?
Yes. So a fund of funds, by definition, is less risky than a direct fund. It also, as a result of that, has more muted returns than a direct fund. But with that, if you raise a right sized fund of funds and you're investing in right sized underlying funds, and you are providing diversification by underlying industry, by geography, by vintage years, by fund iteration, you can you have the potential of having a significant outperformance fund of funds. Um, we in my former firm had returns that would rival many venture funds, and that is driven by proper construction of the fund of funds and proper diversification, but not too much diversification. And if you and having right-sized funds, both the venture capital funds as well as the venture capital fund of funds, really drives outperformance, especially if you're in the best vintage years.
Absolutely. Let's build on that portfolio construction part. So, what are your ownership targets there? How do you look at diversification? So, give us an insight into that.
Certainly. So I don't actually have any restrictions on what percentage of the funds we represent. I believe that if you have conviction, you should be okay having a higher percentage of the fund. It's more a reflection on the fund manager whether or not they're comfortable with an LP representing that a higher percentage of their vehicles. Um, I think about it the other direction, which is in a perfect world in a fund of funds, in my opinion, you have 12 to 15, 15 to 17 underlying investments. So you're providing diversification, but all your core positions should all be ish the same check size. You either are in or you're out. You don't, you're not thinking, I'm not sure. I'll do 50% of a commitment. You're in or you're out. And so having that level of conviction and having diversification by underlying manager is really critically important. In addition, as I mentioned earlier, having diversification by underlying industry is critical. To the extent that you're overweight in a sector, it needs to be very purposeful. And to the extent that you're avoiding a certain sector, really put some thought into that and understand why it is that you're carving out a potential sector, because diversification by industry does matter. To a certain degree, diversification by geography matters. Although in venture capital in the United States, it's predominantly New York and Northern California, although there's been a lot of really interesting funds and really interesting strategies across the United States. And right now, the technology that has come onto the scene is a really nice building block for entrepreneurs that come from domain or industry expertise that are now leveraging AI, or they're leveraging various other technology platforms, and they can build on it to provide products and services for a community or an industry that they know really, really well. And that plays well into the diaspora of venture capitalists across the country.
That's very interesting to learn. And what I've learned is that you're running multiple programs at Recast Capital called Recast Accelerate and Recast Enablement, and a lot of these are focused on bringing up and supporting underrepresented emerging managers. So, can you talk about what are these programs specifically for, and who are the people they support?
Happy to. So, yes, at Recast, we believe in institutional investors having exposure to emerging managers. However, we also believe the data that venture capital is highly competitive. And to the extent that you come from a different background or have different lived life experiences, or you have a different network of entrepreneurs, you're going to produce better returns. And so we also know that, as I just mentioned, a properly constructed venture fund of funds says no a lot more than it says yes. And it has nothing to do with the quality of the managers they say no to. If I already have a investment in a fund that's pursuing a certain industry, I cannot create additional exposure to that industry. Or if I'm done with that vintage year, I cannot add exposure to that vintage year. So my partner Sarah and I both saw this. We had been helpful to the ecosystem more than we just with investment dollars. And we also had never worked together as partners. So 3 years ago, we actually launched Recast with our tuition-free educational program. It runs for 12 weeks. It's largely around how to make your fundraising process more effective and more efficient. That's what Sarah and I know. How to make your deck look better, how to do LP archetypes. I could hear from venture capitalists who were emerging not that long ago, and now they're established, and they're very reflective about what they did really well and where they could have improved. I could literally listen to those stories every day of the year. And then we bring in our friends from the LP and the GP community to talk about these issues. And then we have a lot of opportunity for the community to get to know one another. And consistently, the feedback has been the community loves getting to know other emerging managers in venture, especially if you're a solo GP, getting to really, have a relationship with other managers who are in a similar place as you is very valuable. We also provide 6 sessions of executive coaching for free. They very much value that. Most managers do. And then they value that, at least in our community, there's no dumb question. And Sarah and I say it the way it is. There's no press allowed in the room, and it's a very candid conversation. And so those three elements of our program have been very well received. To date, 96 funds have gone through that program, and it is a very diverse community. One of the learnings that came out of our educational program is that all of this is great. However, it still takes women and people of color 2 to 3 times longer to raise their funds. And what else could we do? So we launched Accelerate as a fiscally sponsored nonprofit that takes in charitability dollars, nonprofit dollars. And in addition to the executive coaching and our educational program, we are paying the operating expenses of this year it was 36 female-led venture capital funds that are early in their journey. We pay $100,000 of their expenses. If we were to give them each $100,000, it would be taxable to them. Instead, we are paying their bills on their behalf as if those bills never existed. So trying to keep them in market longer, especially given how challenging the last year's fundraising market was, we think it's a very important element to advancing the community. And we are going to be tracking all the recipients of these funds over time, with the hypothesis that more diverse general partners end up investing with more diverse founding teams, and the results of that research will be publicly facing.
I love that. That's really commendable work that you're doing there. And we just had Amber Illig from the council on the podcast. And I believe she's one of the beneficiary of this program that you just mentioned. And it's incredible how you're supporting female managers by that program. So kudos to you for doing that. Awesome.
Thank you.
Also, yeah. Courtney, let's also talk about. So you've invested in a good bunch of emerging managers and funds, and you've seen some game film how they're performing over the years. So can you tell us maybe one or two case studies of funds that you bagged and the reason you bagged them?
Certainly. Where to begin? One of the managers that we backed in our fund came with deep expertise in recruiting, how to identify talent, how to onboard talent, how to retain talent. And he had been a very early employee at a very successful startup where he did that. He also was at another startup that did that. And he had a very thoughtful approach as to how he would add value to underlying companies. And he had a portfolio of companies in which he'd already provided these services. So when we met with him, he was very affable. He was very likable. You could see that members of seed stage syndicates might like to work with him. It seemed logical. He also was very articulate about how he was analyzing these early stage management teams and how he was going to be sourcing his opportunities. He also had very impressive co-investors and follow-on investors that had come into his companies. That all those initial data points convinced us to take another call, another meeting. And at some point, we went through all of his existing investments from his earlier portfolio. It was nascent. He had had a couple markups. but he had not had realizations. And going through that portfolio with him made us more excited, not less. So his vision on each of those companies was more insightful than what I could just read on a piece of paper. Where he thought these companies could go was more interesting than what I had thought these companies could go or do or accomplish. And then, you don't get to reference calls, or at least professional LPs do not do on book references until you've got the capital. And if these reference calls come through, you will make a commitment. We did off references with people we know in the ecosystem to validate that he's a good guy, that people like him, that people perceive him to be a good judge of character. But doing the on reference calls, calling CEOs, you don't do until you're in. And so that really ended up clinching it for us. I had one entrepreneur who had a blue chip list of investors, and I said, how did this individual stack up relative to all these brand name venture funds? And he said, it's very interesting. When the Series A lead came in, who had been in the seed stage, I said to, they wanted to not allow any of the seed stage investors participate in their pro rata. And I went to the mat and said, we would not be where we are if it wasn't for this individual. And you at the same time did very little for me. And so, long story short, the fund we backed was able to exercise their pro rata in the Series A. So it's those types of stories, when you get to actual references, that can help to get an LP over the line. If you do those references at the 11th hour and your CEOs are meh, they're indifferent, it does not bode well. So, but it takes a long time for LPs to get to the point of actually calling your CEOs, because they understand how delicate those relationships are.
Absolutely, totally agree. Thanks for sharing that perspective there. And as we can see now, we are in a difficult market now. The capital isn't flowing as freely as it used to. So, what's the approach you are taking? One, at the fund of fund Recast Capital itself, have you slowed deployments or maybe paused the deployments? So, what's your approach there? And also, what's the approach that you're suggesting to your portfolio funds, right? What's the approach they should be taking, and how should they be supporting their portfolio companies who are also in a cash crunch?
So, my husband has been in sales his entire career. And I think his advice is what is needed in this environment. It's a numbers game. There is capital out there. There is less capital out there than there's been. But there are institutions and individuals who are deploying capital in this market. You want to be the beneficiary of their deployment of capital. So you need to be thinking about sales and fundraising like a professional fundraiser or professional sales professional. You wake up in the morning and you are sending out emails, you're making phone calls, you're doing follow up, you are expanding your pipeline of the types of individuals or institutions that might be receptive to your message. There's always, these environments, I've always said, venture is not an asset class. Private equity is an asset class. You don't need to have venture in your portfolio. However, it's one of the only places where you can have this type of performance potential, this type of growth. And you should right size venture within your portfolio and not try and time the market. That being said, it tends to be these vintage years where access to capital is more challenging, where the best returns are generated. And if you're talking to underlying managers, they're seeing that the bar for getting Series A funding is higher. You need to get further along. You need to have accomplished more. That's not a bad thing. You also are having a lot more time to do due diligence. You have a lot more time to get to know the company, to figure out if you want to invest. That's good for the business. When there are less dollars in venture funds, you also have less backing of the B minus companies who end up competing against the company that should be winning. And that creates static in the market. That's good for returns. So it can be very, very painful, but these are good vintage years and can be very attractive times to be investing in the market. So we're big believers. Oh, and the other factor is, unlike other market corrections, of which I've been a part of a few, right before this correction, all the brand name venture funds raised massive amounts of capital. They raised main funds, they raised opportunity funds, they raised growth funds, and they're sitting on a massive amount of dry powder. And at some point, they are going to have to start deploying that capital. That's good for early stage investors as well. So it is a tough time, but it's a numbers game. There is capital out there. You just need to do harder work. You need to turn over more rocks than perhaps you had to turn over, 2 years ago.
Absolutely. It's going to be helpful for a lot of VCs and also founders out there trying to make this work in this market. Awesome. Courtney, let's now move on to the rapid fire round, wherein I'll ask you 5 quick questions about the funds that you're deploying into VC funds, and you have to give 5 quick answers. Sounds good?
Yep.
Awesome. All right. So the first one goes: what are the sectors and regions you invest in?
All. US and Canada only, but within those geographies, we're open to anything.
Great. And what's the typical stage focus for GPs that you deploy in?
Most emerging managers are pre-seed and seed, and you get some Series A exposure, but we're open to other archetypes, but believe that the early stage makes a lot of sense and it's very attractive.
What's the typical check size you put in and the ownership target you try to achieve, if there is any?
We do not have an ownership target. A core position is $3 to $5 million.
Great. And where can GPs apply for funding in case there is a direct way?
So I am active on LinkedIn. I'm active on email, and those tend to be the two best channels to reach me.
Awesome. And where can listeners follow you to learn more about you and Recast Capital?
LinkedIn, to a certain degree, Twitter, and then obviously doing podcasts like these that are captured throughout the ecosystem. And also, our website is robust with content that is for emerging managers in venture.
Awesome. I'll make sure to put all those links in the show notes below. Thanks so much for making time for this, Courtney. It was great having you on and learning about how LPs are approaching this slowdown and how you are trying to bring up even underrepresented managers in the ecosystem and supporting them in every way possible. Thanks so much for doing what you do, and happy investing.
Thanks for having me. Really appreciate it.
My pleasure.